Hi guys, welcome to your own show, MKJ Talks for Investment in English. Guys, large number of you keep on asking me, sir, tell us the trick to identify a multibagger. Sir, we want to invest in a multibagger. You just tell us the trick, the simple way of identifying a multibagger. So guys, today I am here to tell you how to spot out, how to find, how to select a share which can prove to be a multibagger. So for any shares to be a multibagger, it should possess 5 main characteristics as shown on the screen. First is, it should be a debt-free company. You know, debts are the main reason which has made companies to fall and vanish. So it should be a debt-free company. Second is growth in profits. Third is healthy return on equity. Fourth is good management. Fifth is competitive edge. So these are the 5 fundamental things which if a company possesses, then it is most likely to become a multi-bagger of future. And if such companies are available at throwaway price, don't miss the opportunity. You know, stock market is a place of opportunity. Sometimes very good stocks, they are available at throwaway prices. So you should always watch the stock market like a vehicle. Remember my phrase, gone are bulls, gone are bear, eagle is the winner, let's be clear. So you have to act like an eagle. Just keep a watch on stock market, and wherever you find stock market at its low and you are able to spot out a potential multi-bagger fulfilling all these 5 conditions, grab the share and I tell you, you will be a winner in stock market. So I will be discussing all these 5 points one by one with practical real life examples. Let's talk about the first point, almost zero debt. Go for a company which has zero debt. You know, debts are something which have been found to be the main culprit for you can say for a debacle or for a company to get eliminated from stock market. Examples are all the companies of JP Group, all the companies of Anil Ambani Group. You look at these companies are facing difficult times. Their shares have become penny stock. The main reason being they have taken a lot of debts and now they are in position not to service them properly. So taking debt is not everybody's cup of tea. Only very few people know how to take and when to take debts and when to repay them and become debt free. So I'll give you an example of a very good company in India, that is Infosys. You look at its balance sheet, you will be surprised to see there is zero long-term borrowings. This is a true blue chip, and my dear friends, you are lucky because of whistleblowing. This stock at present is available at throwaway price, just around 700. You know, it has touched a high of 860. Just because of whistleblowing, it has come down like anything. But you look at its balance sheet, it's a zero debt company, a wonderful company to grab. You evaluate this company. I'm not encouraging you to purchase this company. I'm not instigating you to go for this company. You should evaluate these companies on the 5 parameters which I am telling you. And if you find it to satisfy all the 5 parameters, then you may think of purchasing this company at the right price. And I leave it on you to determine what is the right price, right? So this is an example of a zero debt company. There are a large number of such companies. Look at TCS. It has also a very minuscule amount of borrowing. Look at Hindustan Unilever. Look at HDFC AMC. Look at HDFC Life. Look at SBI Life Insurance. Look at ICICI Lombard. It also has a very small amount of debt. So the company should almost be debt free. If it is debt free, then with confidence you can say it will be able to meet and face challenges in life with confidence, and it will not fall to its low when the going is tough. So you should select a company which almost is a zero debt company. Now the second point is growth in profits. You should look at, there are 2 things related to a company. One is known as top line and the other is known as bottom line. Top line refers to the total revenue, the total sales. Bottom line refers to the profit. So you should look at both these figures, and if both the items, that is top line and bottom line, are increasing constantly, albeit in a fluctuating manner, but increasing, I mean sometimes the growth is high, sometimes the growth is less, but is growing, then it means it is a very good company. I'll show you an example of one of the very good company of India which has grown like anything and still has all the characteristics of being a multi-bagger for many years to come. And the name of the company is Hindustan Unilever Limited, the topmost company in FMCG, fast moving consumer group category. Now you look at its profit, I am showing its top line and bottom line, that is total revenue, that is total sales and profit since 2015. Look at its sales in 2015, you may look at it consolidated sales or standalone sales, consolidated profits or standalone profits, both are constantly increasing. And now if you look at the sales for the year ended 2015, it is 31,000 crores. I am telling the figures in round, and consolidated are 32,000, and you look at 2016, they have increased slightly to 31,625 and 32,609. And now if you look at for the year ended March 2017, they have further increased to 32,000 and 33,000 respectively. And if you look at for the year ended 2018, they have further increased to 35,000 and around 36,000 respectively. First figure I am telling you the standalone, and the second figure is the consolidated. And now you look at the sales revenue figure for the year ended 2019, they are around 39,000 and 40,000, rounded figures approximately. So every year sales are increasing, although in certain years they have increased marginally, but still they are increasing. And if you look at a 5-year pattern, you will find they have shown healthy growth in top line. Top line means total revenue. Now look at the bottom line, that is profit. Now we'll start again from 2015. 2015 the profits were around 5,500 for both standalone and consolidated. They increased marginally to 6,000 for the year ended 2016 in both the categories, that is standalone and consolidated. They further increased to around 6,200 in both the categories for the year ended March 2017, and they further increased to 7,300 for both the categories in for the year ended March 2018, and further increased to 8,700, 8,800 respectively for the year ended March 2019. Now you see they started from around a figure of 5,500 and 5,600 for the year ended March 2015 and increased gradually to 8,749 and 8,832 for standalone and consolidated respectively for the year ended March 2019. So if you look at both the top line and bottom line, they are constantly increasing. So this is a good company. This is a multi-bagger which is likely to remain multi-bagger for many years to come. It has been a multi-bagger for last many decades and has likely to remain multi-bagger for many coming years. So this is the second feature which you should look into a company to identify a potential multi-bagger. Now let's talk about healthy return on equity. So first of all, you should understand what is return on equity. The amount invested in the company on account of shareholders, or you can say the shareholders' share in the company, is also known as net worth or equity net worth. It comprises of equity share capital plus all the reserves, and it is also known as shareholders fund. If you divide earning after interest and tax, that is after meeting all the obligations, obligation of interest toward debts, obligation of tax towards government, if you consider the final profit figure, that is profit after tax, earning after tax, and divided by total shareholders fund and express it as percentage, it is known as return on equity. So in other words, return on equity is nothing but the percentage return on the investments of shareholders in the company. So this figure should be very good and should increase every year or remain constant, even that will do if it is on the higher side. Now I will take the example of same HUL and show you its return on equity. These figures you can calculate on your own. I have told you how to calculate. Otherwise you can go to any website like Money Control, Economic Times. There these figures are pre-calculated. I am showing you the pre-calculated figures from moneycontrol.com, and if you look at it, the return on equity, net worth, you can call it net worth, equity or shareholders fund, for the year ended March 2019 is 78.8 on standalone basis and 76.95 on consolidated basis. So the figure represents a very high amount of return on the amount invested by shareholders in the company. So greater is this figure, and if this figure remains constant over a period of time or keeps on increasing over a period of time, then it is good. It should not dive down too much. If it is diving down too much, then it means company is not performing well. So this is another criteria of identifying a good or a potential good company or a potential multi-bagger. Now the fourth criteria is good management. You should invest in those companies which belongs to a good management group. And if you are able to identify such company on these parameters in its initial stages, I tell you, you will be able to mint currency in stock market. You know, when HDFC Life and HDFC AMC got listed on stock exchange, I praised them a lot because these two particular companies satisfied all these conditions. And look, where are they now? I started acquiring HDFC Life from 290 onwards. I acquired it till 400. Now it has gone as high as 650. I started acquiring HDFC AMC. I acquired it in its IPO at 1100 and kept on acquiring it from open market till 1800. I remember 1700 or 1800. Now look at its price. It has crossed 3000, and yet they are going to perform. It is expected they are going to perform brilliantly for many years to come. Why? Because they satisfy all these categories. They belong to the wonderful management. If you compare two companies which are almost, three companies let us say, which are almost identical, you will find that HDFC Life is performing comparatively better than its peers. Why? Because its management is the best. You look at HDFC Life, HDFC Life, ICICI Prudential Life and SBI Life. All the three companies are very good. But if you compare them, you will find that market is discounting HDFC Life greater than the other two. Why? Because its background and the management is best. So you should always select a company and invest in a company whose management is free from court cases, free from bad news, free from exploit and blames like they exploit shareholders, free from blames like they manipulate their figures. Then only you will be able to get good returns. Look at Anil Dhirubhai Ambani Group. So many cases are going on Mr. Anil Ambani that he is always involved in solving these cases. I don't understand how much time does he get to manage the companies, and that is why you will find the company's performance are going down, and all his companies in his group, they have become a penny stock. So you should be very wise and select those companies which have a good and excellent management background. Now how to test it? It is very, you write the name of the company and along with the name you write legal cases, legal problems on Google. You will get the list of the problems which that group is facing. For example, you are planning to invest in say Anil Ambani Group and you want to know whether the management is good or whether the management is involved in many cases or not. Just on Google write Anil Ambani court cases. You will get the list of cases, and if you find the list to be very long, avoid investing in such a group. Now you write HDFC Bank legal cases, hardly you will find any Google link. Why? Because they are free from most of the legal cases. Simple operational cases, they are normal, they may be going going on. But there is no case against management or against any debt default. So such kind of companies are beautiful companies to be invested into. So I am, along with explaining all the points, I am giving you very examples of very good companies, and these are the hints, or you can say these are the inklings for acquiring great companies at right price. But the right price you will have to determine. You have to keep a watch on the price of the share like an eagle, and then catch the prey at the right time, that is at a right price. Now the last thing is competitive edge. You should always try to invest in the company which is the leader in its industry. I'll give you a very fine example. Recently, some time back, there was an IPO of Poly Cables. I got 2 or 3 allotments in it. I sold 1 or 2 allotments. I don't remember the exact figure, but I am left with 1 allotment, and the price has appreciated like anything, much above the IPO price. Reason? Because it is the leader in its segment. You look at HDFC Life, you look at Hindustan Unilever. You should invest in a company which has some competitive edge over its peers. Then only you will find that the company is performing more. There might be many companies in the same FMCG category. For example, in FMCG category, you look at Hindustan Lever. I invested in it, I got a very good return. I invested in Colgate, I got a very good return. I invested in Dabur, again there also I got a good return. But I invested in all these shares at the right price. I did not invest in them when they were quoted high. I was just keeping a watch on them like an eagle, and whenever there was a deep correction, I used to acquire. Today only I have acquired shares of 2 good companies at a very deep correction, which I will be telling in my future lectures, and maybe I will be reviewing those 2 stocks for this particular month in Diamond members, because for Diamond members I do a stock review once a month of 1 good or more good companies. So that company I will be including in that list, and if you want to know about it, you can become my Diamond member for my Hindi channel, because there I have member facility and not on this English channel. So you become a Diamond member at that Hindi channel category, and the link of joining for becoming the Diamond member is given in the description box. So you should always invest in the company which enjoys a competitive edge over its competitors. So guys, if you find a company which satisfies all these 5 parameters, so it is my suggestion, just observe it carefully like an eagle, and then acquire the share of such company at a right price. I assure you that you will get a bumper reward for this. Hopefully you have liked my video. If yes, please subscribe my channel and press the like button. Also remember to join my Telegram channel, whose link is given in the description box, along with the link for joining the Diamond membership, and also the link for various platforms that are offering DMAT accounts and mutual fund applying facility at almost 0 cost. So all these links are there in my description box. You should always go through description box of my every video. With this, I wish you bye-bye. God bless you. Happy investing. May God give you lot of money in stock market. Bye-bye.